Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. Today, we are lucky enough to be joined by Jason Trennert. He is the CEO and chief investment strategist at the firm. Jason, how are you doing today?
Doing great, Ross. Thanks for having me.
Yeah, thanks for joining us. We'll kick it off with everyone's favorite topic so far this year, which is inflation. And I think you've done a good job to point out that inflation is not this binary option. It's not 1970 style inflation or sub 2% borderline deflation. We can be in the middle where it's a little above average and a little stickier. You've laid out a few of the reasons you think it'll be stickier over the next 5, 7, 10 years. You can name the time frame, but I was wondering if you could talk through a few of those items and what you think might be the most important on that front to consider.
Well, sure. I think the first thing clearly is that the policy mix that we've adopted, both from monetary policy and fiscal policy, it really could not be more accommodative. And as far as the Fed is concerned, as we know, the assets on the Fed's balance sheet have doubled since the start of the pandemic, and the level of M2 is up by 33%. And if you layer on top of that very expansive fiscal policy, that paves the way for inflation if you don't have more productivity. So that's probably the strongest reason, but there are other reasons. I do think the environmental agenda, as well intentioned as it may be, is going to increase the cost of doing business. It will greatly increase the demand for commodities, and not oil, of course, but other commodities that go into making electric vehicles. And I think there are real questions about the labor market that are more structural, which is to say, we're still trying to figure out why there's 10 million job openings and you still have 4 million people fewer in the workforce than you did before the pandemic hit. I think part of that is just people are a little bit older. I do think the vaccine mandates are a part of that to a certain extent. I also think that the cost of labor clearly on the lower end has gone up. Less skilled workers has gone up pretty dramatically. And so and wages tend to be sticky. So if I put all those things together, I'd say it's there's a decent chance inflation runs at more like 3 to 4%, as opposed to the 1.5 to 2 that we were running at before the pandemic struck.
Yeah. One or two of those items maybe you could hand wave, but all taken together, it might lead or insinuate a kind of regime change here. So shifting to what that means for equities, I was looking through some of the forecasts that you all put out, and I noticed that your 2022 earnings estimate is actually above consensus. I was wondering if you could talk to me about some of the key reasons for that and what that might mean for equity returns over the next year or so.
Well, listen, I think, Ross, it's we're focusing a lot on nominal GDP growth. So as a guide to what revenue growth and then ultimately profits will be. And I'm largely of the view that nominal GDP growth will be higher because I think inflation is going to be higher. So there's a decent chance you get better than expected earnings on a level perspective. Profit margins, though, may be a little bit under pressure. So I do think the chances of a recession next year in 2022 are quite low, just because of the steepness of the yield curve, because of the level of savings, because unemployment claims are coming down. Those are all good things. But I also think that the economy is still in good shape, and you're going to provide the basis for better than expected nominal GDP growth. The question really then becomes, does inflation overtake the real growth and put a lot of pressure on margins? But we feel good with about a 9% increase in corporate profits for 2022.
And then how does that inform your outlook for the actual, projection for a return on equities? I know, starting from where we're at near all-time highs, valuations fairly rich on an absolute level. But on the other hand, bond yields remain pretty stubbornly low. And, with inflation where it is, the yield on things like cash or treasuries, it doesn't seem tenable. So is it a case of, equities being kind of the only option? How does that all kind of come together in your head for an outlook for equities over
Yeah.
the next year or two?
I think, listen, of course, it's more fun when they go up, and I'm always rooting for the highest return possible. But I think it's safe to say, if you're just thinking about it, just trying to deductively, you say, all right, well, I have a 9% forecast for corporate profits, and then say, well, what are the chances for multiple expansion next year? And I would argue the chances are not particularly high, and that's simply because I think the Fed is going to start tightening, and I do think longer term interest rates are going to start to rise. It may be modest, but so I would say, Ross, at the maximum, I would say, just logically, it would be hard for me to see returns above 9% next year, and you may get a little bit less because you'll have some multiple compression once the Fed starts tightening. Having said that, all the things that you mentioned, particularly the TINA thesis, there is no alternative for equities, are still very much in place. And a big part of the return next year will be driven, frankly, by what the long end of the yield curve does, or long-term interest rates. Long-term interest rates can stay relatively low, and by relatively low, I'd say below 2.5%. I don't think there's a big cause for concern as far as equity market returns. You could see something in the 7 to 9% range. If there's a sense that the Fed loses control and the long-term interest rates move up meaningfully above 2.5, that could be something that's a little bit more challenging for the market. And that's why the monetary policy and also the potential reappointment of Chairman Powell, in my opinion, is very, very important.
Yeah, and that'll be something to keep an eye on over really the next couple of days here, something imminent for the markets to pay attention to. Well, I really appreciate the time. That's, I think, a really good outlook and kind of base to lay before we head into the new year. So, Jason, I want to thank you so much for the time. And, if we don't speak again, have a happy holidays as well.
You too, sir. Thanks, Ross. And thanks to everyone out there. And look forward to seeing you all either before Christmas or in the new year.